easiest illustration for bonus depreciation is if you go buy a business vehicle.
Welcome everyone to our Hero Capital show. I'm your host Tim Mai, and today we have my favorite guest in the whole wide world from our 3 years of interviewing the top real estate syndicators, fund managers. I have the privilege to introduce to you guys Jennifer Semien. She is my partner in our Hero Wealth Fund. She has her own tax advising business as well and a CPA, extraordinary human being. I don't know if you know about this or not, but Trump just signed into law the One Big Beautiful Bill Act on July 4th. So just a few days ago. I thought it would be super timely to have Jennifer come on and share with you. I asked Jennifer to come on and share with you all today. Jennifer, thank you so much for doing this for all of us and explaining and simplifying this whatever 1,000-page bill to all of us normal people. Thank you, Jennifer.
Yeah, it's definitely one big bill, over 900 pages long and probably closer to 1,000. So I've just been reading through it for the last few days, just trying to make sure I understand and try to analyze it and the impacts that it's going to have on us as taxpayers.
I don't know if you had this on your slides or not, but do give us a bit of your background as a CPA and all of that good stuff.
Okay. I assume you can see it. Yeah, so again, my name is Jennifer Semien. I actually have a 20 plus year career in accounting prior to coming into real estate full time. I also have a tax advisory firm, but my 20-year career in accounting spans from audit to controllership to consulting. So a very wide range, but at the end of the day, I think it all boils down to providing very high level strategic advisory. And so with my tax advisory firm, that's exactly what I do, where I study the tax law and help taxpayers and business owners and investors apply that to help them save on taxes. So as Tim mentioned, President Trump recently signed the One Big Beautiful Bill Act on Independence Day. So just a couple of days ago. And that essentially is a 900-page bill that includes a lot of things, not just tax reform. But what we're going to cover today is essentially the tax impact that you guys would be most interested in. So what I'm going to try to do, because like I said, there's a lot in that bill, I've tried to pick and choose what I think is the most relevant. So we're going to try to just understand the changes, the new laws. I'm going to try to compare and contrast it to what you guys have been used to in the past. And then I'm going to try to point out some key benefits that you should be aware of, as well as highlight any planning opportunities that you can consider going forward. So this bill, you'll probably hear it referred to as Trump Tax Act or new Trump tax laws, but what it's really technically called is the HR1, the One Big Beautiful Bill Act. And from a tax perspective, what this really does is it builds on and extends a lot of the provisions that were in the Tax Cuts and Jobs Act that Trump enacted during his first term in office. And a lot of those provisions were set to expire either at the end of this year or next year. And so this new big, beautiful bill extends a lot of that and enhances a lot of what was in there. And so the key themes that are present in the big, beautiful bill are basically pro-growth, pro-investment, and incentives in our rural community and areas. So these are the sections that are relevant to us as real estate investors. They probably look familiar to you. A lot of these aren't things that are new. They've been talked about multiple times over and over again under the old laws versus not just what Trump enacted, but also prior to that as well, depending on how long you've been in real estate. Some of them are new, like the QBI deduction. That's actually relatively new under Trump's last bill, but most of them have been around and discussed in the past. So we'll cover most of these throughout this, or at least touch on them throughout this presentation. Okay, so the most exciting news is essentially that 100% bonus depreciation is back. It's not only has
Woohoo!
yeah, I think that deserves a round of applause. So not only has it been restored,
Go.
yeah,
That's
let's
right.
go. Not only has it been restored, but it's been made permanent, at least for the time being. And so this 100% bonus depreciation, it applies to the qualified property, which that definition hasn't changed, but it applies to qualified property that was acquired after January 19th, 2025. And so, in order to take advantage of that for the 2025 tax year, not only does it have to have been acquired after that date, it also has to be put in service before the end of the year. So again, the definition of qualified property hasn't changed. It applies to business assets, most business assets that have a recovery period or a useful life of 20 years or less. So the typical things that we see are like improvements, furniture, equipment, computers, vehicles. Those are the typical assets that we see bonus depreciation being applied to. And then, of course, being in real estate, you know that you use cost segregation studies to unlock a lot of these first year deductions. So, yes, before we move, one big round of applause for bonus depreciation being restored.
Woohoo! Yes, amen. I love it.
Amen.
So the other law or benefit that applies to depreciation is called Section 179. So we as real estate investors, we don't use this one quite as much, but it does apply in a lot of areas, other areas of business ownership. But Section 179, the deduction cap for that was increased to 2.5 million, which was previously 1 million. And the phase out was also increased to 4 million, previously at 2.5 million. So those are the changes related to Section 179. And so you'll see that 179 is useful for things that are above or beyond that 20-year useful life. So this can apply to HVAC systems, roofs, security, fire, or alarm systems, but mainly in non-residential property because it does not apply to residential property. And then, of course, it must be used over 50%. So these things have not changed. These rules are essentially the same. And Section 179 can be used alongside bonus depreciation. But the thing with Section 179 is you typically apply it first because it can't go beyond it. It's capped out. The maximum that you could take, the maximum deduction that you can take is based on your taxable income. So you're able to carry over any disallowed deduction, but using bonus depreciation actually allows you to create a paper loss. So that is why we use it in real estate a lot. That and the fact that it can apply to residential real estate.
Yeah, real quick, I wanna, and we'll make sure we have a Q&A at the end here. But as Jennifer's going through these slides, if you have questions, feel free to put it in the chat. And because I know some of these things, it might go over your head. So we'll make sure we'll discuss it and go deeper into these. But yeah, Section 179 is one of my favorite tools as well. All right, Jennifer, go ahead.
Right? One other one that is pretty relevant to most of us as business owners, active business owners, and very excited to see continue is the QBI deduction. So QBI stands for Qualified Business Income. And it pretty much applies to most active businesses. And what it is, it's a 20% deduction on your pass through income. So if you're set up as a partnership, an S Corp, a sole prop, that pass through income, that income that you earn on your business that passes through to your personal taxes, you receive a 20 up to a 20% deduction on that income. It has been enhanced in that it was phasing out or started to phase out when you were above $100,000, but now that has been increased to 150,000. So what that means is that it doesn't phase out as fast. So you can earn more without taking a penalty or a cut on the deduction that's available to you. The other thing that they did was they created a minimum $400 deduction. So this is applicable to small businesses who have a smaller amount of income. So if they have at least $1,000 of income, they can also take advantage of this deduction with this $400 minimum that's been made available. The qualifiers and what's considered a qualified trade or business, those definitions are still the same. So if you qualified for this deduction, which has actually been around since 2018, since Trump's last Tax Cuts and Jobs Act, this has been around. So if you've qualified for this in the past, you will continue to qualify for it in the future years. So one other thing that changed is the state estate tax exemption doubled. So the previous exemption was $10 million, but it was set to sunset or revert back to $5 million. And so the new law basically eliminated that sunset period and also increased it to 15 million. So it's quite a big jump. So if you're looking to do estate tax planning, this could definitely impact your plan. So you definitely want to get with the person that you're working with or the consultant that you're working with to update any type of transfer activities that you were planning for your estate. Okay, so one of the things that's talked about frequently in real estate investing is 1031 exchanges. This essentially remains unchanged. There wasn't anything that addressed 1031 exchanges, not to change, not to eliminate, not to do anything. It was not addressed at all. And so everything that you're used to, where you have the deferral of capital gains via like kind exchange, that's still available to you. The timeline still applies. So that doesn't change. But I will point out that one of the things that we like or that we pursue or recommend sometimes is called the lazy 1031 exchange, where basically it's not, lazy 1031 exchange is not a formal tax term, but it is a strategy. And it's basically where you sell a property and you purchase or invest in new real estate that qualifies for bonus depreciation and paper losses that will help to offset that gain that you earned on the property. And so this is available to you without the formalities of a formal 1031 exchange. And so with the return of bonus depreciation being at 100%, the lazy 1031 exchange becomes a very viable strategy now that, that depreciation amount is increased. All right. So one area or one benefit that had some pretty big changes to it was the opportunity zone. There were quite a few changes. The opportunity zone benefits had a lot of moving parts to it from the very beginning, from Trump's last bill, the Tax Cuts and Jobs Act. Some of the benefits had already expired or sunsetted, and more were slated to sunset over the next few years. The new investments that were made after some of the deferrals sunsetted were still available and carried forward, but some of the benefits were taken away. Now, like I said, there's a lot of moving parts to this opportunity zone. So what I found was it's easier for me to set it side by side. Just a few highlights here that I have in bold letters is there's new designation rounds that start in 2026 and redesignation every 10 years. There's a new 10% step up in basis after a 5-year investment. And then they've instituted a new thing called Qualified Rural Opportunity Funds, which is going to offer a 30% step up. So just to compare and contrast, because like I said, there's a lot of parts to this, I did create this little chart that shows you the before and after. I'm not going to go through it line by line, but if you want to take a picture of it or if you want a copy of this particular chart, happy to share it with you. But this basically compares and contrasts the old law, which is the TCJA, Tax Cuts and Job Act, which was enacted in 2017, versus the Big Beautiful Bill Act enacted last week. So yeah, feel free to take a picture of that. Again, long story short, opportunity zones are back. They've been revamped, and it's basically almost a whole new set of rules from what it looks like to me. Okay, so capital gains, again, this is an area that is mostly unchanged. Most of us would probably say it's unchanged because the capital gains rates, they still remain intact, as the income thresholds that go with it. The carried interest rules for us as syndicators or fund managers still requires a 3-year hold for it to be treated as long-term capital gains. And then there's no changes to other things like the net investment income tax. That's basically a tax on high earners that have passive investments. There's no changes to the capital loss limits, and there's no changes to the ability to receive a step up in basis. So the one thing that did change that makes it why I said mostly unchanged is that the new bill creates an installment election for farmland gains. If you're invested in farmlands, happy to talk to you about it. But I would say that most of us on this call probably are not. So that was the only change that's included in the bill related to capital gains. Now, that should summarize pretty much everything related to the tax impacts that are included in the new bill. But here is a summary of the impact to us as fund managers, syndicators, real estate investors. So bonus depreciation still continues to pass through to our LPs. Section 79 can be used in active management structures. So again, equipment or assets that bonus depreciation may not apply to, Section 179 is available. There is an order of operation there. So that's definitely something you want to work out and structure with your CPA. The qualified business income thresholds have been increased, and this gives flexibility to fund managers as well as active real estate investors to offset some of that income from your operations or from your business. And then, of course, you want to use entity structuring to optimize deductions and participation. So that's basically saying that you want to make sure that where it's beneficial that you're set up as like a pass-through entity so that these benefits can flow through to you and your personal tax situation. Said another way, some of these benefits are not available if you're structured as a C corporation. So some strategic takeaways is basically we are in July 2025. So that gives us ample, not ample, but a lot of runway to revisit planning, to do planning before the end of the year. And a lot of these laws, or most of them, are effective for 2025. So you're going to want to look at your tax situation and see how it's impacted. I'm going to give a quick example because one of the things that I didn't cover that was included in this bill is essentially the increase on the state and local tax deduction. So I know that if you previously took the standard deduction because maybe you didn't have enough write-offs, this state and local tax deduction could have an impact on whether you would itemize versus, again, taking the standard deduction. Because in the past, we've been limited to $10,000 of state and local tax. And if you have property taxes or state taxes, you were limited to $10,000, it may not have tipped the scale enough for you to itemize. But now, with that being increased from 10,000 to 40,000, there may be more of an opportunity for you to itemize if you live in a high state income tax state or a high property tax state. And then again, like with the change in the estate tax, you might want to review your estate plans, restructure the transfer schedules, look at your income sources again. So, long story short, if you don't have a CPA or tax advisor that you're working with, now is a good time to look into that and create a plan that you can implement for this year. And opportunity zones, if you're looking for tax advantaged investments as far as capital gains and tax free gains, opportunity zones are worth looking at with all of the changes and enhancements that were made under the new law. And then what we've known and what we continue to know is that real estate still is the most tax efficient wealth vehicle. So that is not news to us. So again, if you are ready or you think you might be ready for a strategic tax plan, you can scan this QR code. It'll take you to a short survey so that you can apply for a complimentary tax strategy session. So it's just a few questions to help qualify so I can basically see what it is, where you earn, how you earn your income, what level of income you're in. It's just a few questions to help me see if there is room or opportunity for me to help you. And if there is, I will review it and send you a link to do a complimentary tax strategy session. So feel
All
free to
right.
scan that QR code.
Yes, and then we'll put the link in the chat there for you guys as well, for those of you who can't scan it, especially if you're on your phone. We're gonna go to some of the questions that are in the chat, and then I'd like to go back to some of these slides here and talk more in depth about it. But JP had a question about 1031 and bonus depreciation can combined roll over into new larger property and get bonus depreciation in same year. You might have to go back and look at the question.
Yeah. Okay. Combine. I'm not sure that you would do that. I guess so. If you had a 1031, you would have to complete that within the timeline that's set. And so that timeline extends, if you go beyond the end of the year, it extends to when your taxes are due. But I think what you're saying is that if your 1031 exchange is less than what the property you're exchanging into is less than what you sold, is that basically the question? And then you have what's called boot. Perhaps then you reinvest a portion and take advantage of bonus depreciation in that regard.
Yeah, I could add some color. So maybe one example, right? So let's say there's a smaller property I sell this year, I do a 1031 exchange, let's say $1 million, right? With $1 million, you use it to for kind of the down payment for the loan. You buy a $5 million property, right? And then it's still within the same year. And then could you basically do the bonus depreciation on the 5 million?
There are two separate strategies. You can do the bonus depreciation because what it is, the 1031 exchange is going to offset the gain that you're rolling over, right? And your bonus
Yeah, if
depreciation.
you're not paying any gains, but then use the full amount and then leverage up to a larger property and then take a bigger depreciation.
Yeah, no, they're still, yeah, those are two separate strategies, but yes, you can.
But you can combine them. Because I think when you were saying lazy 1031, like it sounded like maybe they could be like mutually exclusive, but I don't think they are.
So lazy 1031 exchange is basically just an option that's available if for some reason you don't qualify or miss the deadlines or forget to do a formal 1031 exchange. In the past, it's been most beneficial when bonus depreciation was 100% and even 80%, because then you would know, like, you had an exact dollar amount. You had a $500,000 gain and you bought a $500,000. You buy a property that has bonus depreciation of 500,000, then you know you have a 1-for-1 offset. So yeah, so that's how the lazy
It's like a
1031
it's like a workaround basically. Okay, cool.
basically.
Awesome. Yeah, thanks so much, Jennifer. I appreciate it.
Jennifer, let's go back to some of the slides. I think the first one you started was the bonus depreciation. Some of the people I know when I first came into this industry, I didn't really understand how it works. If you can explain everyone how 100% bonus depreciation doesn't mean that if in yeah, let's say if you invest $100,000, that you get a K of 100,000, but it doesn't mean that if you owe the 100,000 in tax liability, that K can offset against that liability 1 to 1. So it's based on your tax bracket and all of that. But can you explain about that, and also that how it requires you to be a real estate professional to be able to not just offset your passive income, but also offset your active income? I know that those are two completely separate things, but if you can explain that so people here know how it works for them and then how it works for their investors that might not be a real estate professional.
Yeah, so there's a lot to unpack there. Okay, so let's start with bonus depreciation as it is, right? So I want to say, and I'm not saying this is a good strategy, and I'm not recommending that you do this, but I feel like the easiest illustration for bonus depreciation is if you go buy a business vehicle. So you buy a car, the car costs 80,000 and you use it 100% for business, it would qualify if it meets the weight requirements and everything. It would qualify for 100% bonus depreciation. So that's 80,000. You would be able to reduce your business income by that amount. And so it directly impacts or reduces your taxable income, right? Now, the difference is that when we're talking about real estate, the IRS classifies real estate as a passive investment. And so passive income, passive losses can only offset each other unless you're what's called a real estate professional. And there's another exception to that, which I'll cover in a minute. But if you're a real estate professional, then you can use, let me back up. If you are not a real estate professional, real estate losses are considered passive and can only offset passive income. And most of us have what's called active income, which is W-2, 1099 income that we actually work for, not that someone else works for and gives to us. So that if you have bonus depreciation, and let's talk about how you get that, to take advantage of the bonus depreciation on real estate, you would do what's called a cost segregation study. And so let's say you bought a property that was $1 million, and let's say 200,000 of that was the land value, 800,000 of that was the improvement, building, everything else value. And so that $800,000 asset you would apply a cost segregation study to that to determine the useful life of every single component within that $800,000 asset. And then the things that have a useful life of 20 years or less, those are the items that or property that bonus depreciation would apply to. And so you're going from $1 million down to 800,000, right, which is the property. And then you're going even further from there because then you're segregating it into the useful life buckets. So let's say that 800,000, let's say that 60% of that, or let's just say 50 to keep it simple, 50% of that was 20-year or less useful life recovery period, then that $400,000 is what you would be able to apply the 100% bonus depreciation against. So there's a little bit of math involved in that. But then what happens is that $400,000 of bonus depreciation essentially gets offset against the other income from the business, other expenses added to it, and it creates what's called a paper loss. And that is usually what we see on our K1s that we get from syndications that our investors see on their K1s. And so that paper loss is created from this bonus depreciation. And when investors have that paper loss from their K1, again, it just depends on what type of income you have that for it to be able to offset against. I don't think we're going to get into we don't have enough time to get into real estate professional status, but basically what that does is to qualify for that, you essentially have to be an active real estate investor, and you have to spend a significant amount of time and participate in real estate businesses. And when you're able to do that, you unlock what's called the real estate professional status. And what that does is that unlocks your passive losses to be able to offset against active income. So without going into a lot of detail, one of the key scenarios that you'll see with that is like in a couple that's married, one has a W-2 profession or job or career, and the other spouse manages the rental portfolio. The one who's managing the rental portfolio could very well qualify for real estate professional status. And when that unlocks real estate professional status, they can do cost segregation studies and take that bonus depreciation on their rental properties, and that bonus depreciation can be applied against the other spouse's W-2 income. So that's essentially a very simple example of how it works. Unfortunately, a lot of our investors in syndications are passive investors, so they don't get to take advantage of these paper losses. But what does happen is those paper losses get carried forward, and when the property exits, then they're able to use up all of the carry forward losses.
Very good. Thank you.
The one thing that I did not get to mention, and that the one thing that I want to cover, is with bonus depreciation, there is a loophole, and it's called the short-term rental loophole. When I said earlier that the IRS considers long-term rental real estate as a passive activity, short-term rentals that have a limit on the number, like the average days that a person stays or a tenant stays, that actually doesn't qualify, or it's not classified as long-term rental real estate. And so it is not considered a passive activity. So when you hear the short-term rental loophole, basically what they're saying is that it's real estate, it's rental real estate, but it's not long-term rentals. And what happens is, because it's not long-term rentals, it's not automatically considered passive. And so you have a easier threshold of participation in that activity to be able to unlock those losses. So then again, you would go through the cost segregation study process and then calculating that bonus depreciation. And then that bonus depreciation you can apply toward your active income. So let's say you're a single person with a high income job, high income W-2 job, you could invest in short-term rental real estate to offset that active income.
Very good. Okay, Barbara has a question. When you choose bonus depreciation, do you consider how long you will hold the property, since you will have to recapture that depreciation? For example, plan hold of 5 years.
Yeah, unfortunately, there's no way to escape depreciation recapture other than a 1031 exchange. And that's just the plain truth of it. I think there is a way to get out of it in the opportunity zone investments as well. But depreciation recapture is going to be there. Whether you take the depreciation or not, you're going to have to pay some sort of depreciation recapture. Now, when you take bonus depreciation, yes, that depreciation recapture is going to be bigger because you're taking a larger amount and you're exiting a lot sooner. Yeah, if you think about it, the bonus depreciation applies to property that is less than a 20-year useful life. Yeah, so if you exit before 20 years, or really most of the property is made up of 5, 7, and 15 years. So it's going to be a math exercise of how much you have to pay. And also there's 2 different sections. So some things under one section and some are under the other. And one section, you recapture everything. And then the other section, you only recapture the excess. So it's a bit of a complicated calculation, but there really is no way to get around it other than either not selling the property or 1031 exchanging.
And the long-term approach is that you keep on deferring it, 1031 exchanging it, and then at some point you stop selling and you just pass it on to your kids, which then they can take advantage of the step up in basis where they're only responsible for the taxes from the capital gains from the time that the value of the property from the time that it's passed down to them, to the time that they sell it.